This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Oli on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Oli's picture saying looking for the downloads.
Patrick, let's start with the S&P 500. I said a few weeks ago I thought the S&P could easily rally to 6,500, and well, that's exactly what's happened. We're technically overbought here, but with the usual caveat that therefore a pullback is probably in order. I think eventually this rally can continue higher until there's a bearish catalyst. A hot inflation report was the risk that's behind us now, at least till next month anyway. Everybody's acting, though, as if this Ukraine war ending is almost a done deal. I'm going to say more skepticism is warranted. I hope it's close to a done deal. Let's see what weekend actually brings. Patrick, what are the charts telling you in terms of the S&P?
Well, Eric, the 65 to 6,600 level on the upside are a number of measured moves. So you're bang on in terms of some of these upper targets. But let's talk through the price action of the last 2-3 weeks to really size this up. So back in mid to late July, we were saying this market was incredibly overbought and due for one of these 5% market corrections. And the jobs numbers triggered that. But that correction ended up being incredibly fast. It was about 3.5% from peak to trough and ended within days. And what we've now seen is the market rallied back to their highs. Now, usually, if the market is in a topping formation, it usually starts to struggle up along the highs. And even especially this week is the options expiration, which tends to have gamma pinning. And yet, the bulls managed this week to punch through to a fresh new high, which continues to show that the bulls remain in the driver's seat and there's clear buying momentum still in the market. Now, that doesn't change the fact that once you're 4 months into a market rally, that inevitably a much bigger market correction, which is just more of a mean reversion than necessarily a crash, will inevitably come about. But right now, there isn't much in the way of technicals that are suggesting that that has begun. At this moment, further bullish punches toward the 65 to 6,600 are the path of least resistance. And really, with a lack of news, the next kind of inflection points could be Jackson Hole or the September jobs numbers. So the bulls definitely have several weeks of time to continue to try to press some of these upper levels before we probably see a catalyst that could inevitably cause some sort of a correction to occur that would see some sort of reasonably short period of time where the market could trade below that 50-day moving average and have one of these 5 to 10% market drops. Overall, the market here is in bull trend, and we got to see where that next kind of moment where the market can turn emerges. All right, Eric, let's talk about that U.S. dollar index.
Patrick, all indications are that the counter-trend rally in the dollar index failed and the secular downtrend is, in fact, back on. My ultimate target for the Dixie is still 89, but there will probably be at least a couple of counter-trend moves between here and there.
Well, Eric, we're over a week now of trading below the 50-day moving average. More importantly, all rallies are failing, which basically means that that short-lived rally that we saw in late July on the upside of the dollar immediately got derailed by the jobs numbers, and we're now trading back to some key support lines, which are all established around the 97 level on the dollar index. But the most important thing to think about is where the weakness in the dollar is coming from. And it's coming from the European currencies, the two currencies that continue to actually drive much of the weakness in the dollar is the euro and the pound sterling. The yen and the Canadian dollar and Aussie dollar are much more muddled and certainly not where there is any momentum. So really, if the dollar was was to have a big breakdown move down to 96 or 95 on the downside, it almost certainly looks like it will be coming from a breakout to fresh highs on the euro or the pound sterling, making an advance. So those are the two currency crosses that I would continue to focus on, to seeing whether dollar index is still destined for a little bit more weakness. All right, Eric, let's move on to crude oil charts.
Well, as of Wednesday's close, we were below all the moving averages, looking pretty darned ominous as of the close Wednesday. As of recording time, early Thursday morning, the overnight session saw an attempt at least to try to rally back up to the short-term moving averages. If we can get back above the 100-day moving average at 63.50 on the September WTI contract and stay there, okay, maybe the bottom is in, but so far, until we see any real sign of a reversal, the trend is down. We took out the moving averages. That probably portends lower prices still to come.
Yeah, Eric, those support lines from June and July around the $65 level where there was a Fibonacci retracement zones completely gave out. And we are now trading, again, over a week below the 50-day moving average in pure distribution. Now, I was looking for these support lines to hold. So with the fact that this is broken down, there is no denying that the bears are in the driver's seat on the short term. Where are the different targets? Well, at this stage, the crude oil futures going back to retest April and May lows just below $60 is certainly on the table. The bigger question is that will some catalyst occur, such as, for instance, the situation with Russia and the Ukraine, pivot something where the oil markets have some sort of rate reversion. I think that there is geopolitical risks that could trigger that, but at this stage, we would need a meaningful rally above $66 on crude oil for us to undo the technical damage that's being done right now. Right now, that primary downtrend is intact and one has to be respected. All right, let's talk gold.
Well, Patrick, this correction makes perfect sense on a fundamental basis, given that the mood of the markets has been an expectation that Trump and Putin are probably going to make meaningful progress toward ending the Ukraine conflict when they meet on Friday. And still lower numbers would make sense, at least briefly, if there is, in fact, some kind of peace deal that comes out of this weekend. So I could easily see a big gap lower on the Sunday open if there was actually, an end to the war that was reached as a result of this peace negotiation. But the fundamentals are still very much bullish for gold beyond any potential unwind of the geopolitical hedges. So I say that potentially maybe we get a deeper pullback if there is a resolution to the Russia-Ukraine situation. If so, I think it's a buy the dip opportunity.
Well, Eric, when we take a look at gold, we had a extraordinary bull run since the start of the year that ran into April. It was close to a $900 rise in gold. And so having seen a consolidation pattern develop was something that we talked about for the last couple of months. Now, we thought that there was room for gold to make breakout attempts all the way back in June, but we find ourselves deep in this trade range as gold continues to just grind in a sideways manner. But what is particularly interesting is that generally gold miners remain very bullish. Silver was very quickly bought on dip and advanced back to its highs. And platinum and palladium, while they've corrected, still are in primary bull markets. And so at some point, when this trade range resolves itself on gold, that could put it all together where precious metals all make a simultaneous big punch, particularly to the upside. This is on the table, but clearly gold has not yet indicated. One thing that's interesting is we're trading right at the 50-day moving average. This is a very interesting little spot to see whether gold traders buy the dip and work it way back up to 3,500 to show that some form of accumulation is still underway here. Okay, moving on. What are your thoughts here on uranium?
Well, it's already mid-August, and we've still yet to have a meaningful correction in uranium. The fundamentals couldn't be more bullish than the long-term contracting market is finally starting to see some activity. So I really think that this market is coiled up for a big move higher. The big catalyst we need to see is the spot price of uranium moving. And really, the real market for uranium is in the term market, but the spot price is what everybody's watching. That's what we need to see move in order for everyone to feel comfortable really repricing this market higher. My one big fear is everybody who's at all interested in or open to this kind of investment is pretty much already all in, as am I. We're all convinced that this market is really going to take off after the WNA conference, which has been a reliable seasonal catalyst in the past for the beginning of buying season for the long-term fuel contracts. Now, I think there's plenty of sense for that to play out exactly as all of us are expecting. If what we see is the spot price of uranium catching up to the term price, moving higher after the WNA conference as the physical buying and the actual market starts to heat up, I think that really green lights the market moving much higher. But wait a minute. If everybody's pretty much as far in as they can get until we see that spot price moving, I don't think there's much room for any further speculative exuberance. We've already seen as much of that as we've got, and it's all going to get unwound from the uranium mining shares if for some reason things don't go as expected, where we see this market start to take off after the WNA conference in early September. So, let's say there's a broad market risk event that also happens after Labor Day. If that happens and it potentially sucks the uranium market with it, and then a whole bunch of people who were just sure that it had to take off and ended up getting over leveraged on margin get shaken out of their trades, it gets ugly very quickly. So that's what could go wrong. But frankly, I just don't see how that could happen unless there was something outside of the uranium market, such as a broad equity market risk event, in order to catalyze it. I can't see it happening other than that or something like a worse than Fukushima-sized nuclear disaster someplace. Short of that, I just don't see how this market can't move higher. These nuclear reactors have to have more fuel. They've already burned down their reserves. They've got to buy more fuel. It's a question of when, not if they buy more. When they do, this market has to move.
Well, Eric, I continue to think that uranium is asymmetrically skewed bullishly to the upside at the spot prices. But at this moment, it continues to be incredibly quiet. But when we get to the equity side, the equities have had just an extraordinary run on the upside and are finally showing some little heaviness. And one of the things that I'm going to be watching here is whether or not the bulls can punch to a fresh new 52-week high on things like the URA, or whether this is beginning some form of a distribution cycle where we may have a pause. We could have a scenario where we mean revert, 10-20% on many of these equities on the downside. And while that number seems intimidating, we want to put it in context that we had over 100% rise on the upside over the last 3-4 months. So them just pausing here and mean reverting is the typical type of price action that's exhibited in almost all securities. After it takes a little bit of a break, a resumption in the bull trend is definitely the path of least resistance. But the market is definitely starting to get a little bit heavy on the uranium equity side. So, Eric, what are your thoughts here on copper?
Well, Patrick, it looks like they're finally starting to buy the dip on the HG copper futures contract, the American copper futures. I continue to see this as a long-term buy and hold position long. Definitely bullish copper in the long term. The question is, can we repair the damage on this chart and maybe get a decent rally going to retrace all this damage that was done? If we can get above the 200-day moving average, which is up at 4.75, it's about 20 cents above the market right now. If we can get above that and stay there, I think maybe this rally could have legs and we could see a significant retrace. just from the looks of things on my chart, the whipsaw up on the tariffs when President Trump shocked the market higher with the threat of tariffs, that happened from a price above $5. So we've got, more than $0.50 of upside from here just to get back to the beginning of this whipsaw that started with an upside move in copper when we thought tariffs were going to apply to U.S. copper imports. And then there was the big downside when we found out they weren't. Well, we haven't gotten back up to where we started yet, so it makes perfect sense to expect that retrace. That's what I'm looking for in the next couple of weeks.
Well, Eric, it's quite difficult to actually technically size up the copper futures market when you're looking at the COMEX chart because of all of the tariff pop and drop. But we can identify a couple of key things. One, there is the multi-year low down around the 4 to 4.25 level, which at this moment makes the purchasing of copper at least asymmetric in the sense that you have a major support line to support your downside risk. And if copper works its way higher off of this dip, the upside potential is arguably much higher than the downside risk, which makes it interesting. But very likely after such an extraordinary move, the rest of August may end up being far more range bound as the price needs to settle in a little bit before resuming some sort of a new trend. So while I like the asymmetry of copper here, I also think that one needs to expect to be patient on this, as it's not likely going to be a big mover right away.
Patrick, before we wrap up this week's show, let's hit that 10-year Treasury note chart.
Well, Eric, on that 10-year Treasury yield, it is clearly in decline. Lower highs, lower lows. We're at a major level around this 420 level. If this gives out, we might be heading down to 4% levels, something we haven't seen since the April crisis, or you have to go back to mid-2024. This certainly is potentially an indication that the economy is weakening and expectation for lower rates is imminent. And so the 10-year definitely weakening at a major support line here. Let's see whether or not the coming week drives a breakdown of these levels.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.